Hi guys, welcome to my channel. Today we'll discuss Block 1, Chapter 2, Growth and Structure of Indian Economy. Question: Examine in brief the different phases of growth of Indian economy since 1991. So from 1990 to 2008, the trend average annual growth rate of India was just 6% during that decade. During 2003 to 8, growth rate of real GDP was 8.2% annually and population growth rate was around 1.1% per annum. Sustained economic growth rate was of 8% due to various policy initiatives taken by the government, such as trade policy reforms, that is, significant reduction in tariff and non tariff barriers, revamping of industrial policies, that includes withdrawal of industrial regulations, liberalization of foreign direct investment, coupled with favorable external environment that leads to increase in export, increase in foreign capital flows. Three engines of growth are: first is the consumption spending, that is a major contributor of economic growth, since reduction in price will lead to domestic and global competition, thereby increasing exports and income of people. Second is investment in new capacity, that is characterized by certain lumpiness because investment spending increases at the starting of investment cycle and reduces abruptly once the desired investment capacity is created. And third is the export of goods and services. India's merchandise export got diversified geographically, therefore less vulnerable to local business cycle. But the major weakness was the labor intensive manufacturing remained sluggish, that is the small scale industries reservation in most labor intensive products did not had the intended outcomes because of labor market rigidities facing large scale producers, infrastructural bottlenecks, bureaucratic red tapeism. Now, during 2008 and 14, the growth process slowed down during 2008 and 9 in the wake of global financial crisis, which resulted in fall in inflows of foreign direct investment, increase in outflows on account of portfolio disinvestment, reduction in exports order from developed countries, resulted in slowdown of domestic investment, employment, and consumption. Slowdown affected all sectors. Decline in service sector are attributed to lower demand for offshoring and IT enabled services from US and Europe. Financial services such as banking slowed down on account of increased interest rate and investments were scared to invest their fund in stock market. Real GDP growth rate slowed down to 6.5% in 2011-12, continued to be low in subsequent year 2012-13 and 13-14 due to emergence of NPAs crisis, double balance sheet problem, NPAs non-performing assets. The major concern was sharp dip in the growth rate of private consumption. Four factors attributed to this slowdown was: first, due to the wealth effect resulting in fall in asset prices. Second is uncertainty in labor market and increase in unemployment. Third is cutback in consumer credit by banks, NBFCs, and other lenders, limited deposit base, and difficulty in secondary market financing. Fourth is the dominance of precautionary motive may induce consumers to defer their spending decision or shift to lower quality alternatives. Since people, rather than spending on high quality products, choose to buy alternatives that are at cheap price though have lower quality. Slowed down in the gross rate of gross fixed capital formation was an area of policy concern. A significant stimulus package in three tranches was put by government involving expansion of G and reduction, that is G is the government expenditure, and reduction in indirect taxes to boost domestic demand from 2014 to 19 and 2019 onwards. From 2014 to 19, annual growth rate of real GDP increased to 7.5 percentage. Several initiatives were taken by government to spur growth include government 4R approach, that is recognize, resolution, recapitalization and reforms to strengthen banking system, simplification of labor laws, relaxing foreign direct investment rules, easing KYCs for investors in capital market, more support to NBFCs, HFCs and MSMEs, introduction of indirect tax reform in form of GST, the good and service tax, introduction of IBC, that is Insolvency and Bankruptcy Code, for speedy resolution of insolvency and bankruptcy of companies, demonetization to curb black money and counterfeit notes, and which in turn opened gates for cashless economy. India's growth moderated around 5% in 2019 to 2020 from 6.8% in 2018-19 amidst weak environment from global manufacturing, trade and demand. Economic state from 2019 onwards may be identified as a pause phase. During this phase, clouds of uncertainty over India's economic performance and prospects got bigger and darker. India's economic growth slowed down, domestic investment slackened and could get worse. Inflation was monitored, country's external imbalance increased at the time when capital flows are volatile. Investment momentum was below its trend. Persistent weaknesses consumption is concerned. Service sector is slowing down. Growth in agriculture may take a hit. Fiscal monetary mix was completely out of work, hardly any flexibility on fiscal front. The impact of COVID-19 on Indian economy has largely disruptive in terms of economic activity as well as loss of human life. Almost all sectors were adversely affected as domestic demand and exports sharply fall, with notable exceptions where high growth were observed. Annual growth rate during 2020 to 2021 was minus 6.6%. Tourism, hospitality, and aviation were the worst affected sector. Consumption got impacted due to job losses and reduction in income of people, especially daily wage earners. Greater uncertainty and repercussions of COVID-19 was also seen on the financial market, which was extremely volatile. Likelihood that three major components of aggregate demand, that is consumption, investment and net exports, are likely to be subdued for prolonged period of time. On supply side, shutdown of factories and result that resulted in delay in supply of goods from China affected many Indian manufacturing sectors. Some sectors such as pharmaceutical electronics faced eminent raw material and component shortage. India's growth rate during 2022-2023 was 8.9%. Thank you. Please do like, subscribe, and share my video. And if you like my video, do subscribe my channel and please comment which next video you want me to make for you guys. Thank you.